Dr. Abuga Mokono Isaac, going to take you the course unit, Contemporary Issues in Financial Management. The course unit is designed basically for students who are in their fourth year, that is the final year, presuming that these students have gone through financial management as a course unit. That is, they have studied financial management 1 and 2, and now they are focusing on application of financial management. Now, here we have the objective of the course unit. We are expected that by the end of this semester, we should have achieved the following 2 objectives. One is to apply financial theories and contemporary financial practices to business issues, and 2, to addressing emerging issues in finance and integrating the knowledge in areas of business valuation, risks, as well as international finance. So our main focus is on how to apply the financial practices which we have learned from the previous lessons. If we have a recap of financial management, we'll be able to remember that when we were studying about financial management, you focused on how the companies or corporations are able to source funds, as well as how they are able to use the funds, as well as auditing the funds. So in that case, you covered on what is expected for you to understand in terms of the main sources of financing, of which a business can be able to source from within the firm. They can source from offering shares. They can source from friends. They can also be able to source it from banks in the form of getting the loans. Then from there, once you have got the funds, then you are supposed to think of how you are going to utilize the funds. Before you utilize the funds, there's somewhere you might have learned that you must be able to evaluate the projects or the investments which you have to make, of which you have to evaluate it using different techniques which are being used in budgeting, like NBV and etc., for you to be able to make a decision in terms of what you have to invest. So since you are having all that information of financial management, now it's also very important to know that as time goes by, things are also changing. What used to happen in the 90s is not the same thing happens on the 2000 onwards. It's not the same thing which are happening in 2020. A number of things have gone through. For example, we know that there is a number of financial crises which has happened. We started with the depressions of the 1930s. We had the financial crisis of 2008, and now we are having another crisis which has been brought about by the pandemic, which we are calling the COVID-2019. Now, when all these things happen, they affect the business environment where we are supposed to operate. And when it affects this business environment, it also affects the finances of these particular businesses. So any serious CEO or manager in a particular organization, he has to factor in all those changes which has happened around, because all these external effects, they do affect the way the business operates, hence they affect the way the financing also happens. For example, when the financial crisis did happen in 2008, before that we had the Enron brothers. If you can remember the case of Enron brothers, about the way they gave the false information to the public, which led to the fall of the company. Now, all those crises, they affected the cash flow as well as the working capital of the particular business. So the business has to change its own strategy towards the current issues. And that's why now here we are focusing on the issues of financial management. Of course, there are other issues related with marketing, other issues related with the banking. Now here we are concerned about those issues which are related with how these particular operations manage their finances. So the important issues, all the topics which are focusing on in financial management, one is the workforce, of which the workforce keeps on changing as the external environment also change. We have the data analytic. All the current businesses, they are dealing with big data, of which someone needs to have the concept of data mining. How to be able to generate all this data, how will you be able to process the data so that it can be able to assist in the decision making. Without doing that, you cannot be able to manage big organizations. If you are talking about Safaricom, if you are talking about KCB Bank, if you are talking about Cooperative Bank and other businesses, these big businesses, what helps them in terms of their decision making is the kind of information they have in their boardroom. And that information is what helps them in order to know about the consumers, about the products, as well as about the government. By understanding all that information, you must be able to have an adequate information. Since there is a big stakeholders involved in the whole process, also the data required is too much, and this data need to be generated. And the biggest issue here is how to process this big data. If I'm dealing with 100 customers, if I'm dealing with 20,000 customers, that one I can be able to manage. I can be able to study their behavior. I can be able to study about their frequency, buying, and etc., and I'll be able to make the decision. But when they go beyond those numbers, then it requires that someone needs to be there who is an expert in data so that he can be able to process. So we are looking on about the data analytics, as well as financial management and digitization. That is how digitization has impacted the way financial management has to operate. Then also another issue we have is about the capital budgeting and information embedment. How the limitation of the information does affect the process of capital budgeting, of which we are checking whether have we come up with different techniques of budgeting, or we are still sticking to the traditional one. And if we are sticking to the traditional one, are we able to get enough information to assist in utilizing those techniques? Also, we look at the cybersecurity, because all the information we are dealing with, it operates within the internet, and this internet, that is the interface of the internet. It involves a number of people. All these people, there is a way they can also be able to preach that is the laws in terms of the operation of this internet, which can affect the business, as well as whether there is any impact in terms of the regulations which are there to govern financing, as well as the aspect of transparency. So all these have been put together in order to have a clear picture on what we are supposed to focus if we are talking about the issues of financial management. Now, to start with, about the workforce, who are very critical in terms of business. Anything which we are dealing with business, the products, etc., all of it, they are linked with the people who are operating it, right from the top management to those people who are working at the lower level management. So the millennial workforce has changed the way business run, and the majority of these employees choose flexibility. They don't want to be limited, or they don't want to be restricted in terms of the space where they have to operate from. Because the millennials, they have studied under the digital era. They can be, the gadgets are there which can enable them in order to operate from where they are. And for that reason, they prefer that so long as they are able to do the job, it doesn't matter where they do it from. And because of this flexibility in terms of the workforce, they like to balance their personal life as well as the work life. They need to be happy, they need to take care of their families, as well as they need to operate. As well as they actively pursue and exploring the world, bettering themselves while also, that is, doing work. So technology is an enabler in the revolution of work, and cloud computing ensures that the employees can connect anytime the employees can be able to connect anytime they want. So this changing workforce also requires that any serious financial manager somewhere must be able to factor in that now, if at all we are going to have meetings, not necessarily that we must be able to meet physically, we can be able to operate from where we are by using the video conferencing or by using Zoom and etc. They can be able to operate the business. And that one, it means what? So by making it that flexibility, also it saves the time which the people are supposed to engage in interacting together. So they can be able to operate wherever they are. And at the same time in business, mobility of labor is a very big factor. Mobility of labor is a very big factor. Now, if these people can be able to operate under this kind of flexibility we are talking about, then you can be able to have someone elsewhere. If you think that there's an expert in other countries or there's an expert somewhere, that person can be able to operate from that point without even moving physically. And that one makes it easier for any company to be able to source these people. So you can be able to get efficient people at any place you want, and they can be able to do the job efficiently the way it's expected by the organization. So the changing workforce, also the financial manager needs to understand that and needs to see whether when there is this kind of flexibility, is it able to reflect when it comes to the costs or the expenditure of the organization, as well as the revenue which the organization is able to generate. However, they say that as much as we try to consider that, when things are changing, there is no way we can be able to go back. If these people, they have grown with the technology, and there's no way again you can tell them that they have to go back to the traditional. So the only option which is there is that how can we be able to accommodate these new ways of doing things, these kinds of flexibility, at the same time trying to ensure that the company is also able to run in terms of making profit. The other aspect is the data analytic. And data analytic is about customers and their behaviors. And decision to be made by the manager or the financial manager or other managers, it requires that they need to understand about the customer. And the customer behaviors itself, it involves a number of things in terms of their preference of the product, their behavior in terms of the pricing, their behavior in terms of the closeness of the product, and etc. In order for you to be able to have all this information, you need to go out there and collect it. So that's why we are saying that data analytic is very important, and it involves knowing about the customers and their behavior towards the product. And in this case, you're focusing more on the financial product, and any financial manager will be concerned to know what their customers prefer and what they don't prefer. So by getting this information, data analytics can help to improve the customer experience and increase the speed and efficiency and find the competitive edge. All those companies which have excelled, it is because they have understood the customer. Just like now, if you can recall in the past, actually 20 years ago, for you to be able to sell the product, if it's a physical product, you have to say that you have given a commission, or you have to say that you have given there's what you call as an allowance. If, for example, the product was costing 1,000, you give a discount of 10% like that. So by then, they used to increase the price. Then they increase the price by 10%. Then they give you a discount of 10%. But the current customer is different. The current customer is different. A customer of the 21st century is different in the sense that he has the information. So there's no way you are going to convince him on that aspect of discount. The only thing you can convince the customer now is about what kind of experience he is expected to get from that particular product. So instead of producing producing something in order to convince the customer, is to know the customer in order to produce something for which fits them. And for you to do that, it requires that you have to get the information. And some of the products, they are very expensive to make. They require a lot of investment. And since they require a lot of investment, you cannot just come up with the product without first assessing whether the customers are available. You must be able to determine who is going to buy the product before you offer it. Even the banking sector, before they come up with different types of products in terms of the loan product as well as the saving product and etc., they must be able to understand what does the customer really want. On that basis, they can be able to provide that same to the customer. So data analytic is something which is very important now, and there is a lot of information which is required, and the customer himself keeps on changing, and for that reason, we need to understand them better by getting the information. Then another very important is the digitization thing, the financial management and digitization. Now, the advent of digital technologies continue to mobilize far-reaching social and economic effects, where organization strategies for growth and structure of the entire industries are predicted on technological changes in many areas of business. But technological change can produce varying magnitude of effects. Now, the digitization is whereby now we don't have, for example, with the banks, we don't have the banking hall where everyone has to go there physically. Now they can be able to use the internet, they can be able to use the mobile money in order to be able to get the service. And because of that digitization within the financial sector, it has also affected the way the financial managers have to make decisions. Now, the factors which are characterizing the modern commercial environment, one is the new infrastructure for wealth creation. There are a number of facilities now which are available, which people, that is who are customers or clients of these institutions, can be able to use in order to be able to generate their wealth or to add their value to their money. We have new business models which are there. Given the changing environment, the digital era, now people are changing the way they operate business. You don't necessarily need to have a physical place where you have to to establish your business. You can be able to establish it online, and you can be able to do business. At the same time, the way most of the financial businesses, they are being structured, like now the governance of the financial institutions, the board of governance and etc. Now they have to change the way they have to operate their business. In terms of the board meetings and etc., now they have to be done online and all those kinds of things. So the way the business has changed, it requires that they have to find a different methodologies they have to apply in order for this particular business to be successful. And also new sources of value. In this case, we are talking about the new sources of knowledge. There is a lot of knowledge now than 10 years ago or 20 years ago. So for that reason, for anyone who has to operate the business, he has a lot of work he has to do in terms of able to get this knowledge as well as processing this particular knowledge so that it can be able to produce wise decisions in terms of financial management. Now, how does this digital era affected the economic activities? New products and new services have emerged at a pace that closely matches the rate of technological advances, and the use of digital technologies hasten the rate of innovation and the speed at which new products offering evolve. Any business now, what matters is how they can be able to catch up with the new technology which is in place. How can they be able to operate within that particular environment? Any financial manager somewhere must be able to know what are the new technologies just come, what are the new products they can be able to offer using that particular technology. Because now it's like a process whereby an idea has to use the technology in order to produce the decision. So we are expecting innovation, and innovation cannot happen without using the existing technologies. That's why, for example, Kenya is famous with M-Pesa. It is known worldwide. That is a big achievement within Kenya itself. Of course, we are not so sure whether it was fully Kenyan or it is from outside, but it was a new technology, not new technology, but new innovation within the financial sector, which has facilitated more financial transaction, and it has led to more financial inclusion. Now, accessing funds, even now, if at all the government want to give some financial transfer, M-Pesa becomes very easy for them to do that. And that's what has made it easier, unlike when we didn't have it, whereby everyone has to go through the bank. And in economics, there's something they say is that the velocity of money is very important in economic development. And this velocity of money, it means how many times a particular amount of money can be able to exchange hands. If it is 100, this 100, how fast it takes to change from one person to another within a particular period of time. So the faster it moves, the more it encourages the transactions. So digital businesses have made it very possible that more transactions are able to be done within the shortest time possible, and for that reason it is able to reach to increase the economic growth. So the financial managers, it is a big challenge to the financial managers to see how best they can be able to utilize the existing technology in order to be able to increase the performance of the institutions which they are operating in. Now, the impact of digital on the economic activities, it has an impact at two levels. One is at the managerial level, and the other one is at the macro level. So at the managerial level, firms will seek to analyze strategic issues, pricing approaches, quality factors, and an array of other financial implications which are affecting the enterprise economic viability and success. So all these aspects which are related with strategic issues, strategic decisions are made by the Board of Governors, and for them to be able to make these strategic decisions, they have to use the digital or technology in order to increase the precision in terms of the decisions they are making. At the same time, they are using it in order to enhance quality of the products they are offering. In order to avoid much complaints from the customers, you can be able to produce the products using this digital or this technology, and you can be able to reduce those dissatisfactions among the customers. Now, at the macro level, forces of change affect how financial and management accountants operate within the digitized organizations. That is, management accountants, they have to operate with the existing technology. New softwares have come. So they are not going, because we started with the way they were operating by using the fiscal books, we had new softwares which they are able to use in order to reduce some errors and etc. And as time is going by, every organization wants to be up to date with the current technology. And the technology itself, it helps them in order to reduce the challenges which might involve in those aspects of management accounting as well as financial management. The other aspect is about the capital budgeting and information embedment. And financial manager, capital budgeting is very critical for him to be able to succeed within the enterprise or the business is operating in. Capital budgeting here refers to the planning, control processes associated with the capital expenditure. And capital expenditure are expenditures for projects not intended for immediate consumption, but for the future consumption. So for this capital expenditure, the work of the manager is to ensure that the capital expenditure increase or at least maintain the capital assets of that particular organization. Now, to determine or to make the decision in terms of what kind of expenditure they have to make, because we have the current as well as the capital assets. Now, the capital assets, they are expected to increase the productive capacity of the organization. It's just like when we are investing on a particular assets which is expected to generate money. We can buy a machine, or we can invest on shares, or there must be something which is expected to generate more, which generated more revenue. So that process of budgeting depends entirely on the information which they receive. If you get the wrong information, then you may not be able to make the right decision on what kind of assets you have to invest in. So currently, there is a lot of investment opportunities available. But all these investment opportunities available, also a lot of informations are also out there about those opportunities. So for any serious financial manager, he must make decisions in terms of what kind of expenditure you have to engage in. Now, to make it in finance, there is a way they do it. They have to do some evaluation of these investments. We have different methods they are using. The internal rate of return, they can use the net present value, and etc. Also, there are some new methods which have come in, which are supposed to use in order to evaluate the viability of a particular project. So any financial manager must be up to date with those new techniques for him to be able to be in a better position. Otherwise, it is a very sad thing for a financial manager to invest on a particular project with billions of money, and that project ends up losing. Like now, we have a number of organizations which have closed down, or others are struggling. Like we have the Kenya Airways, which is struggling. We have Uchumi, Nakumat closed down, and all those things. We had financial managers there. They made decisions, but now the problem is that either the decisions they made was based on wrong information, or the decision they made was not implemented properly. And for that reason, it led to those particular problems. So capital budgeting is very critical, and it is very useful on the basis of the kind of information they get to apply it on the techniques which are utilized in that process in order to be able to make the right decision. So the uncertainties related to the future operations and the time value of money associated with capital expenditure decisions create informational embedments not present for decisions associated with operating operating expenditure. Now, the need to focus the consumption time path of initial capital expenditure and the need for focusing additional future costs is very critical for the organization. That is how best you are able to see, or you are able to project about the future is very critical in terms of the success of the organization. They say that a good manager must be an ego who is able to see before others are able to see. So future revenue and return cash flows also need to be forecasted, as well as there is need to determine the appropriate cost of capital to be used for discounting future cash flows. And for you to be able to do that, you must get the information. But now this information may not be adequate because of some challenges, like now there is sophisticated methods of selecting capital investments, which may not be available to all the managers. Asymmetric informational and capital budgeting. Asymmetric, it means that there is no equal information among the players. There is always the receiver and the giver. All of them, they are expected to have equal information for them to be able to make the transaction. So if one has more information than the other, then it means that there is problem of asymmetry. And also the problem of post-auditing capital investment, how they can be able to do the assessment of whatever investment they have made in order to be able to accept that whatever they have done is the best option they have done. Now, there is also the challenge of cybersecurity. As much as we are using the technology, all this digital era is faced with a challenge of ensuring that the information we get from the customers, that information is private and it's protected. Now, the recent time there is data breach where people rush to the bank or it's up to change their passwords and security questions. Financial sectors should be investing on innovations in security, e.g. the use of biometric sensors as extra layers of security. Because before, for you to be able to withdraw the money from the bank, it is just your signature which was very critical. You are able to sign and you are able to get the funds. But now, since we are using the mobile money, we may not be able to be there to sign physically. So for that reason, even we are able to sign, that is using technology, whereby they can sign it electronic signature, and they can be able to do that. But also we have people who are also clever enough to the sense that they can be able also intercept that information and be able to use it in order to affect or to withdraw money from the account or to affect other businesses. So any financial manager must be concerned about how are they going to protect the data which they have got from the customers. And the only thing he can do is to ensure that there is enough investment in terms of security. And security itself also needs another technology in order to counter the other technology, in order to ensure that whatever information available within the organization is secure. So we have different challenges also in terms of regulations, because an organization, in order to operate, it has to work under certain specific rules. And those rules are there in order to protect both the organization as well as the public who are part of the stakeholders of the organization. So the regulatory challenges in the financial sector, one is strengthening the enterprise risk and governance. That is, they are able to manage the risks, transforming the effectiveness and sustainability of compliance, examining possible new approaches to managing capital and liquidity, as well as managing complexities of cross-border regulatory standards. Now, for the aspect of the cross-border regulatory standards, since we are operating on the global, that is the global arena, different countries may have different regulations. Of course, for accounting and most of the finance things, they tend to have a uniform regulation in terms on how they are supposed to do the bookkeeping and etc. However, there are other issues related with the taxes and etc., which varies from one particular country to another. So those diversities of regulations, they bring a challenge to any financial manager who is manning a particular institution. Adjusting to the changing scope of consumers' financial protection, emphasizing cybersecurity while protecting the consumer data privacy to ensure that the information of the consumers are well guarded, addressing the pressures which are brought about by innovations and new market entrants, because any organization cannot just stay without adapting itself to the new technologies. If it does so, then it means that they have made a decision to close down. So there is a big challenge for any organization to cope up with the new technologies which are available within the market. Compliance and surveillance of the financial crime to ensure that they are able to be more vigilant in terms of their operations so that they can be able to reduce the number of crimes which are committed within those particular organizations, as well as reforming regulatory reporting. Because as time changes, also a number of things has to be adjusted in terms of the way the business operates, whether it is buying and selling of the products or the governance aspect itself, it adjusts, and for that reason, even the way the information is reported also has to be up to date with the current technology, as well as using the data aggregation and reporting for improved enterprise risk management. So all those regulations are very critical within the organization, and since every organization has this regulation, then they have to make some adjustment within the regulations in order to be in line with the current improvement or the current development in technology. Also, a very important aspect is transparency. From the regulation itself, an organization, especially an organization which has registered itself in the stock exchange or listed in the stock exchange, which means that it can be able to access funds from the public, then it's required also to be accountable to the public. Accountable in what sense? These public, they have invested money within these particular institutions, and for that reason, they are required to be accountable in terms of the financial statements, how the companies are operating, and etc. So that's why transparency is a very key issue. And see, as time goes by, also the expectation in terms of transparency also keeps on changing. That is, there is more demand for transparency within these particular institutions. There is an overall demand for accountability and transparency from every corporation and institutions, and that leaves the firms in a dilemma. That is, transparency is very important to any customer. They can only be loyal if they are able to get the correct information about the organization. The moment they find that the information they have about the institution is not the correct information, then also they will not be loyal towards that particular institution. And that is a very critical aspect within the financial management. So all these issues are very critical, and as we have seen all through, any financial manager needs to look at them and needs to keep on updating himself in terms on how he has to approach them so that the organization can be able to improve. And that is all for today, and I hope we'll be able to meet for the next lectures in the coming days. Thank you.
These televised lectures supplement our robust online learning going on our MKU online platform. You can view more on our televised lectures via our online platform. We are in a digital era, and Mount Kenya University knows this. The following are the steps to follow so as to complete your online application. Download the application form from the website www.mku.ac.ke. Attach copies of your academic certificates and ID. Pay the application fees via M-Pesa pay bill number 270988. Your ID is the account number. 2,000 shillings is the charge for a postgraduate. You can also deposit in the bank accounts provided on the website. Then email all the above to apply@mku.ac.ke.